Deep downturn or recovery? Where is Singapore's private property market headed in 2015? Welcome back to Money Mind. Sluggish or lifeless? That's how some observers have described Singapore's private property market in 2014. But will 2015 be any different, or will there be more doom and gloom? Money Mind's Frederick Lim turned to some real estate experts to find out. Show flats around Singapore are seeing fewer and fewer visitors, where not so long ago they were bustling with crowds. Observers say that the market is locked in a three-party stalemate, with all three sides playing a waiting game. There is, first of all, the home buyer, who's waiting for property developers to lower prices as oversupply looms. Then there is the developer, who is delaying launches and holding prices while waiting for the government to tweak its cooling measures. There is also the authorities, who are waiting for the low interest rate environment to normalise and for real estate prices to fall even further before relooking their property curbs. So who's likely to blink first and abandon the waiting game? Property experts say that home buyers have good reasons to keep on waiting.
The last 10 years of new supply of private residences is about 8,000 units per year. This year, we are going to complete more than 20,000 units, and the following year, more than 20,000 units. So, if your 10-year average supply per year is 8,000, and this year we have double 8,000, next 2 years we have 2.5 to 3 times of 8,000. How are you going to absorb all this?
Developers have made rich profits before the property boom subsided in 2013. Most can afford to delay launches and hold prices.
They will hold and they will find ways and means to hold the prices. I don't think there is a need to clear because there is no compulsion by my bankers, and my balance sheet is pretty strong. So I will maintain the price for as long as I can.
And the authorities insist that home prices are still at elevated levels.
Most analysts out there agree as well that, generally speaking, I don't think the policy is likely to change anytime soon. The state is likely to allow the market to further correct first until it comes to an acceptable level of change or correction in the market before they'll lift the policies.
The factors that gave rise to this so-called three-party stalemate are also interlinked with other factors that will drive the property market in 2015. In general, a host of factors are at play in determining real estate prices and transaction volumes. They include the economy. Is GDP growing strongly? Will interest rates rise? Is the employment rate high? Are wages going up? Is there liquidity? The demographics. Is the population growing? Are marriages rising? The market sentiment. What are buyers' and sellers' expectations? The government? Are housing policies tightened or loosened? Overseas demand. Are foreigners keen to buy? Property analysts say that some of these factors could be positive for the real estate market in 2015. Singapore is expected to see moderate GDP growth in 2015 of around 3%, with employment staying high and wages on the uptrend. Interest rate rises are likely to be gradual or may even be delayed.
The interest rate situation could drag out further than 2015 and 2016. So we would expect, because so many central banks are continuing to print money and continuing to be holding on to very loose monetary conditions, that interest rates may not go up until end of 2016 or maybe even now 2017.
But other factors like immigration tightening are negative for the real estate market.
How it pans out depends on where the economic conditions are. Whether there is positive economic growth to allow more immigration to come in to support the rental market.
Foreign demand is also seen as negative, as additional stamp duties are putting overseas buyers off.
For the moment, we should take away the foreign demand element from the equation.
To Savills, what is key to the real estate market in 2015 is rising individual wealth and the liquidity that it creates.
Singapore market is driven more so by the liquidity that is piled up by the individuals. What the measures have done is basically lifted the height of a cup that was filling with liquidity or water. So previously the fluid was filling up at the same rate, at a certain rate, and reached the brim, it flowed up. What TDSR did was just to lift the height of the cup, and water is now flowing over. But if you believe that the rate of filling up of this cup is at the same pace, sooner or later it will reach the brim and will start overflowing again, meaning demand will come back into the market after a while.
For Century 21, the oversupply issue is key.
The next 3 years, we will see record high supplies every year. So much so that the 3-year total could be almost 200,000. Actually, it's more than 3 years. It is whatever is remaining of 2014, then 15, 16, 17, plus a little bit of supply in 2018. So within the next 3 to 4 years, we would have up to 200,000 HDB flats, ECs, and private properties being completed.
To JLL, government policies will be critical to how the property market performs.
The policies are likely to remain in effect and the market is likely to continue to soften until we see further.
For the record, the recent drop in Singapore private property prices has been gradual, falling only about 4% so far from the recent peak in the third quarter of 2013. Since 2009, property values have risen some 60%. For 2015, market sentiment is expected to be weak, with private property transactions at 8,000 units or lower. Analysts say that prices could fall by 4 to 8%. But Savills says a surprise could be in store.
Everyone seems very gloomy about 2015, but to be honest, I think it may surprise on the upside. If you believe that the analogy that the liquidity is filling up the same rate, and sooner or later, it will start overflowing again.
In the meantime, the three-way stalemate or waiting game is not going away anytime soon.